Hi, I'm Danny Michael, founder of Satori Wealth Management, and today I'm going to be talking about health savings accounts. You've probably heard about health savings accounts before. They're really, really awesome tax advantage ways to save for healthcare expenses. And today I'm going to talk about what they are, eligibility. So how do you qualify for one, and also all the benefits that they offer. Um, so let's get started. So what is an HSA account? An HSA account is essentially a type of savings account that lets you save aside money on a pre-tax basis to pay for qualified medical expenses. So pre-tax basis, again, that's just like making a 401k contribution or a 403b contribution at your work. So this is money that that doesn't get taxed. It gets removed from your income prior to being taxed. And as long as it's for to pay for medical expenses. By using untaxed dollars in a health savings account to pay for deductibles, co-payments, co-insurance, and other expenses, you may be able to lower your overall healthcare costs. One thing that HSA funds generally cannot be used to pay for are premiums, insurance premiums. So eligibility. And let me kind of zoom in here a little bit. So for eligibility, you cannot be claimed as a dependent on someone else's tax return or covered by an eligible health plan such as Medicare to qualify for HSA account. So that's one thing is, you cannot be a dependent on someone else's tax return. And then the second point here is that if you're covered by an HSA eligible health plan on the first month that you plan to contribute, then you can be eligible to contribute. And that plan has to be a high deductible health insurance plan. So a health insurance plan with a sizable deductible, and for that bigger deductible, you get to pay lower premiums, right? So this is a really good type of account for someone that doesn't have a lot of healthcare needs. You don't go to the doctor, a lot. And so you want that tax benefit of making a contribution to a account, and then you also have lower premiums, right? And then, again, if you go to the doctor, you pay out of pocket, but again, you can use your health savings account. And again, if you're not going to the doctor a lot, then you're not going to have a lot of health costs. And so you have to have a high deductible health plan to qualify to contribute to a health savings account. In the year that you want to contribute. Now, if you're employed by your employer, a lot of employers today do offer HSA accounts, and if they don't, they may offer a high deductible health plan, and you could still open a health savings account on your own. And we'll talk a little bit more about that. So what can you use health savings accounts for? You can use them for quite a few different types of expenses. You'll notice this is not a comprehensive list. Just Google IRS publication 502 because there's too many to list here that won't fit on the screen. It's a pretty wide range of expenses that you can use your health savings account for. So you can see here things like acupuncture and therapy that are not traditionally healthcare costs that your traditional health insurance would cover. You can use your health savings account for those types of expenses. So it's a great account that, again, has a lot of flexibility on the expenses that you can use the funds for. So what are contribution limits? So as long as you have that high deductible health plan, in 2023, if you're an individual, so you file single on your tax return, you can contribute $3,850 per year. If you're in a family, if you file jointly family health plan, you can contribute $7,750 per year. So remember that's totally pre-tax. That amount is completely pre-tax. So it's just like getting a deduction on your taxes. And if you're age 55 or older, you can add another $1,000. So you can make another $1,000 contribution, and that's what we call a catch-up contribution into the plan. So, opening an HSA. So, like I said, a lot of employers today offer HSA accounts along with high deductible health plans, and you can typically enroll during your benefits period. Some employers offer to contribute or match your contribution. So that's another thing that you're going to want to try to determine is when you have your open enrollment period and you're looking at the different plans, there's usually going to be like I said, a high deductible health plan option for you. And then also, try to find out if your company will match or put in a certain amount for you. That's also a good incentive. Now, if they do contribute to you, it still counts as part of that contribution limit, right? So kind of going back to that previous screen, if you're single and and it's 3850 for you, and your employer adds $1,000, then you can only add another 2850. Okay. Um, Absent an employer plan, most large banks and investment companies also offer HSA accounts. If you just do a search, again, you can do a Google search, HSA accounts, just Google that simple term. You'll see a number of financial institutions offering HSA accounts, and so you can open your own account. You can also use the money in your HSA to invest in stocks and other securities, potentially allowing for high returns over time, depending on what financial institution your account is held. So, if you open it at like a bank, so they're not going to have brokerage options there, then there's going to be very limited investment options. But you can open an HSA account with companies like Fidelity or other types of investment companies or institutions where, so you put in the money every single year. Let's say you didn't use the balance in that year. Well, the funds now stay in there and you can invest them and they keep growing over time. So, theoretically, what you can do is make lots of contributions to HSA account. You get this tax benefit up front. And the real benefit of these accounts is when you take the money out for the qualifying medical expenses, there's no tax, right? So this actually takes the benefits, if you're familiar with IRAs and Roth IRAs or, 401ks and Roth 401ks, the way that those work is, an IRA or a 401k, you put money in pre-tax, or in the case of a 401k, if it's an IRA, you get a deduction for your contribution, right? And then all the money when you take it out is income taxable to you, right? So you pay whatever your income tax rate is in the year that you take it out. That's the tax that you have to pay on that. With Roth IRAs and Roth 401ks, you put the money in, you don't get any tax benefit in the current year. So you're taking money you already paid taxes on, you put them in a Roth, but all the growth, because you didn't take any kind of deductions, all the growth on that money is 100% tax free. So when you go to make a distribution from a Roth down the road, you're not going to pay any taxes, right? So what an HSA does is it basically takes those two benefits and combines them together, as long as you're using the distributions for medical expenses. So you got pre-tax money coming in and then tax-free money coming out. There's really nothing else out there that's like that. So very, very, very unique type of an account. And so that's why it should be considered as an option when you're looking at your healthcare coverages. So here's some other facts that are that are important to note is, you can make a one-time IRA contribution. So you can move money from your IRA to your HSA once in your lifetime for federal income tax deduction. So definitely consult with your, with your financial professional, financial planner, or accountant. But that's one way you can start to fund an HSA account, is moving money from an IRA. And then the other thing to take note of is that HSAs are much different than FSAs. A lot of people are more familiar with FSA accounts that's called flexible spending account. And those have been around for a longer period of time. And I think that's why a lot of people are more familiar with them, and employers have offered them for a longer period of time. But basically what an FSA is this is an account offered by your employer that, you can't take withdrawals from that account. You can only use it for expenses. And if it's not used by the end of the year, you can't roll over the balance to the next year. So it's kind of a use it or lose it type of an account. And so an HSA is much, much different because, again, it's controlled by you, the individual, the account owner. You can take withdrawals. There's a penalty if you don't use them for qualified medical expenses, but you can still take the money out. And then there would also be tax if it's not used. Income tax is also due if you're not using it for qualified expenses. But again, contributions can be rolled over to the next year. So you can roll these over to future years and accumulate a balance. And what's great about that is then in retirement, now you have this nice account that you can use for things like copays and deductibles and your prescriptions, and the money that comes out of that is 100% tax free. And then, the last point to note is that, the HSAs can be used for non-medical use without penalty after the age of 65. So again, why they're a great type of account for retirees to have, because after 65, you can use them, pretty much for any kind of needs that you have. You can use them at the grocery store, or anything that's an expense that you want to use those funds for. So again, just to summarize, HSA accounts are just a great account. A lot of financial advisors and financial planners like them because of these tax benefits we talked about. Again, you have the ability for your balance to grow over time. They're really, again, great for someone that's not going to have a lot of medical expenses. You don't anticipate a ton of medical expenses. And also, the higher tax bracket that you're in, the better they're going to be for you, because they save you money on taxes, right? So the more tax you pay, then the more deductions, the more pre-tax ways to shelter income, the less tax that you pay and the more beneficial it is for you. So that's HSAs in a nutshell. Hope this video was helpful for you. Until next time.